Hey folks, Jason Pound with Jericho Pound Realty Group. We are a real estate team under the auspices of Keller Williams Mullenix in Norman, Oklahoma. Jericho and I recently did a study to find out what the top 50 questions being asked by people who are interested in buying real estate are, and today is question number 2. Question number 2 is, where are mortgage rates headed? The answer? Nobody knows. Nobody has a clue. Nobody has a crystal ball so they can tell the future. However, we do have some data back here on the board that I want to share with you guys, which will help you make some of your predictions on your own. My job is not to tell you what to think. My job is to show you how to think. So, first of all, notice Fannie Mae and Mortgage Bankers Association. These are two of some of the largest buyers of mortgage-backed securities in the United States market. For most lenders, when you borrow money, they sell that loan out on the open market and investors buy those. And these are two of the largest groups that are bundling those deals. That is one of the reasons that I love my preferred lender, Mike Hobson at Union Home Mortgage. His company holds the loans on the books. They don't sell them, and you don't have to figure out where to send your payment every single month. That being said, Fannie Mae is predicting by the end of the year, interest rates should be at 5.9%. The Mortgage Bankers Association is predicting by the end of the year 2026, not the end of 2025, but the end of 2026, rates are predicted to be between 6 and 6.5%. So let's take a quick history lesson. When we look at the history of interest rates in the United States, from 1971 to 2025, the high has been about 18% and the low has been in the 2s. The average rate experience of your average customer in the United States getting a 30-year mortgage has been 7.71%. Now, if you have a loan that is below 7.71%, that is considered cheap money. If you have a loan that is above 7.71%, historically, that is considered expensive money. However, most people have gotten used to, get my finger out of the way, most people have gotten used to the 2s, the 3s, and the 4s, and they feel that 5s and 6s are high. You just haven't lived long enough and don't understand how the world works. We're probably never going to ever see those times again. Those were special and unique times. Anything below 7.71 is considered winning in the game of history and borrowing money to buy a house. So now that you have your expectations of where rates are headed by the pros, and you see where rates have been in the past, let's break it down a little bit further of how you actually wind up with your mortgage rate. There is something known as a 10-year Treasury note. If you wanted to invest money into some of the safest places on the planet, one of those places, theoretically, is the United States government. And right now, if you give the United States government a lump sum of money for 10 years, they are going to pay you 4.155%. So you walk into the bank and ask for a 10-year CD and see what they're willing to offer you. Most of them won't offer you a 10-year CD. Most of them are willing to go out to 4 or 5 years. But the federal government is willing to step up and say, hey, we are willing to give you this rate for 10 years. What bankers do is they take that 10-year Treasury note and they add 2 points to it. So, for example, today, the rate by the government is 4.155, and rates today ranged from 6.24 to 6.37. Notice that gap is not exactly 2. It's 2.08 up to 2.215. Why the difference? Well, that's called the competitive marketplace. Some banks want to make a higher profit than others, so they charge a little bit more spread on their money. Other banks are trying to attract customers, so they drop their rates to attract customers. In the big scheme of things, it's always right around 2 points. Sometimes a little higher, sometimes a little lower. So that's a good rule of thumb. If you're tracking mortgage rates, just watch the 10-year Treasury note, add 2 points to it, and you'll know approximately what interest rate you're going to be charged. My left hand's getting tired. Let's move to the right hand. Now, what causes the 10-year Treasury to move? Why does it go up and why does it go down? 3 big things to think about. One is watch inflation. Is inflation heading up or is inflation heading down? As inflation heads up, the Treasury note tends to head up with it. As inflation is headed down, the Treasury note tends to head down with it. The goal is to provide the American taxpayer a place where they can put their money, invest it, and hopefully make more than make more than inflation. That's the hope for those funds. So as inflation moves, the Treasury moves. Next is the debt position of the country. How safe is it to invest your money in the United States government if they owe more money next year than they owe this year? Think about it as if you were loaning money to a next door neighbor. As their debt goes up and down, your willingness to lend them money goes up and down. And that's what this debt position is doing to the 10-year Treasury rate. Is the more debt we owe, the more the government has to offer to entice people to invest their money into investing into the government. Finally, macroeconomics. I'm not going to do a lesson on that. I am an economics dork and I love it. Just realize that there are powers way above our pay grade that are determining what's happening to the 10-year Treasury note. And as a rule of thumb, most bankers are just adding 2 points on top of that and turning around and lending it right back to you. That's where mortgage rates are coming from. Where are they going? Keller Williams economists are predicting that we're going to be in a plateau or a lull for the next 12 months, the next 9 to 12 months, which puts us out to third or fourth quarter of next year. If certain politicians get their way, the interest rates are going to go down, which is going to cause a housing boom, which is going to cause prices to go up. If other politicians get their way, rates are going to go up, which is going to further put the brakes on the housing market, which is going to continue to curtail demand on into 2027. So at the end of the day, we don't know what's going to happen, but now you know when it happens, why it happened. Be safe, my friends.